Hey all, as some of you may have seen in my community tab update, I failed my 50k Apex evaluation account last week. Not gonna lie, it definitely sucks to have spent 34 trading days on this account and even get to within $400 of the profit target, only to fail the evaluation. I did use this account to test out price action scalping, which was a brand new way of trading for me, so the account actually lasted longer than I expected, but I can't help but still feel disappointed with the outcome. On the bright side, trading this account and ultimately failing the evaluation helped me gain a number of important insights, both about the technical aspects of price action scalping as well as about trader psychology, and I wanted to share some of the most important insights with you all. The biggest takeaway from this whole experience is that it's just so incredibly important to follow your risk rules. It was definitely not a coincidence that I was able to keep my account alive for 31 days straight while following my risk rules of stopping trading after 3 losses. Then, as soon as I decided to break these risk rules on the 32nd day to take some YOLO trades as documented in my last video, I ended up breaking them again shortly afterwards, which ultimately led to failing the evaluation. It's ironic that I even said in my last video that breaking your risk rules and getting away with it was so dangerous because you start to think that you can do it again, which is exactly what happened. The hard truth is that breaking your risk rules even once can be a slippery slope, as it can make you less disciplined and mess up your trader psychology. I thought that it was okay to break my risk rules and take YOLO trades if my account was close to liquidation, but I actually don't think this is a valid reason anymore because of the harm it can do to your trader psychology. I've decided that even if my account is ever near liquidation in the future, I will still follow my normal trading plan and risk rules no matter what. Next, on the topic of YOLO trading, I want to clarify that in my last video, I only considered them YOLO trades because if I had lost any of those trades, I would have either failed the account or taken a massive loss. There's actually nothing irresponsible about sizing into trades as long as the context is right and your trade plan allows for it. Adding to losing trades can be risky because you might be adding to the wrong direction of a trending market, which may eventually blow your account if you're too stubborn about it. But adding to losing trades actually works quite well in ranging markets. To mitigate the risk of getting caught on the wrong side of a trending market, you just need to set your max risk per trade so that your account can handle multiple losses in a row, and stick to those limits when sizing in. You can always start with a small initial position and add size as the trade develops. Just make sure to adjust your stop loss so your max risk per trade is within your limits. If you have a reward to risk ratio requirement for your trades, you can also adjust your profit target accordingly to meet your requirement. In this respect, adding to losing trades could actually make your profit targets easier to hit. I still strongly believe that the chance of any individual trade winning is directly dependent on your reward to risk ratio. So as long as you're properly adjusting your stop losses and profit targets after adding size, you still have control over your trade probabilities. In trending markets, if you find yourself on the right side of a trade, sizing into winning trades can be very profitable, and this is actually something that Tom Hugard recommends doing. I plan to start opening trades with one contract and consider sizing in, depending on how the trade develops, as this allows for some additional flexibility if price moves against me but starts forming a trading range. This brings me to my next takeaway, which is that the market context is more important than the actual setup itself. By market context, I'm referring to identifying trend lines, determining whether it's a ranging market or a trending market, identifying breakouts, failed breakouts, and breakout pullbacks. Market context gives you your entire trade thesis of why you want to go long or short. The actual setup, which for me is the two-legged pullback in the form of second entries and failed second entries, is purely the opportunity to allow you to enter the trade. Setups give you some structure and some additional confidence in your trade thesis, so it doesn't feel like you're entering trades at random price levels. I realized that the way I was trading this account was looking for setups first, and then trying to justify the context for the trades. The problem with this is that if you look hard enough, you can always find a reason to take any trade, and this frequently led to me not seeing the market clearly and taking low probability trades. I logged every trade I took on the account and calculated my over win rate, which was no joke, exactly 50% after taking 136 trades. This is clear evidence that my trading plan didn't have any edge whatsoever, and I think it's because I was focusing on the setup over the context, when it should be the other way around. Failing the evaluation with a 50% win rate brings me to my final takeaway, which is that trading profitably on a prop firm account is actually harder than trading your own account because of the strict rules. All Apex evaluations have a trailing liquidation threshold that trails your maximum account value, which is why even after having a 50% win rate on the account and an ending balance of 50,112, which was above my starting balance, I still failed the evaluation. This is definitely annoying, but I understand that prop firms set these strict rules because they want the best traders to prove themselves before they get to trade with the prop firm's capital. Unfortunately, these strict rules are also a way to get more people to fail so they can collect more account fee revenue. I can't blame them for that because the account fees are actually just so ridiculously cheap with all their sales. I bought a few more evaluations to take advantage of the current 90% off sale, which ends May 1st. You can use my link in the description and coupon code to get your own accounts for 90% off. I view these small account fees as a small price to pay for a tremendous upside of withdrawing 100% of the first $25,000 from each paid account. I don't think any other prop firm can match how cheap Apex accounts are or offer such a big 100% withdrawal bonus. On that note, I've actually decided to start trading a paid account next week on this YouTube channel. I have a few paid accounts that I paid lifetime fees for a while back that I've been saving for when I felt more comfortable with price action scalping. Even though I ultimately failed this evaluation account, I do feel a lot more experience with price action scalping, having gained some key insights as shared in this video, and will be more inclined to follow my risk management rules with more at stake. I also practiced a lot this week off camera, focusing on context over setups, and had great results, which has been another big confidence booster. Since I definitely want to make the paid account last for as long as possible, I plan to only trade with one ES contract for most setups, and will consider sizing into 2 contracts if the context is right. The goal is to withdraw a total of $25,000 from the paid account to get the maximum 100% bonus, no matter how long it'll take. Every single trade on this paid account will be documented here on YouTube for all to see, whether in the form of trade recap videos or community tab posts, so make sure you subscribe if you haven't already. The next chapter of this journey is about to begin.